How did a reclusive college dropout turned hedge fund manager with an office above a taco shop find Monster Energy and ride the greatest stock of all time? He had a proven strategy, and this wasn't a one-off. Over 11 and a half years, the S&P 500 turned 10k into 11k, whilst his fund turned 10k into 60k. I'll cover who he is and his proven strategy, how he held on to Monster Energy during the worst stock market crash since the Great Depression, and his 4 deadly sins for avoiding losers and picking winners for stock investing success. In 1999, a college dropout starts a hedge fund in Salt Lake City, Utah, in a small office above a taco shop. His name is Allan Mecham, and his fund is Arlington Value Capital. He also works with his business partner, Ben, who looks after all the marketing side to bring in new investors into the fund. And that allows Allan to focus solely on the investing side and finding the greatest investments. In a 2012 interview, Allan describes his investing style as old school, looking and reading through lots of annual reports to find his investment ideas. In an investor presentation from 2011, he actually describes his investing strategy. Allan's investing philosophy focuses on 4 key areas. We view stock as ownership in a business. We let volatility work to our advantage. Arlington Value strives to be conservative and invest with a margin of safety. We exercise patience and discipline to only invest in exceptional opportunities. Above all, we think vigilance towards risk is central to solid investment returns. So he goes into each one in a bit more detail. We view stock as ownership in a business. The overarching principle of our investment discipline is to approach buying stock as though we are buying the whole business outright and retaining management. Employing an owner's mentality helps us tune out distracting noise, allowing us to focus on the long-term fundamentals of the business, as opposed to the daily gyrations of the share price. So that means it's really important for them to be focusing, if they're retaining management, to be focusing on finding great management teams. We let volatility work to our advantage. On average, individual stock prices fluctuate more than 75% in a 52-week period. We don't believe volatility equates to risk. We welcome volatility as volatile markets occasionally offer extraordinary opportunities. So quite contrarian in thinking that most investors are afraid of the market or stock price going up and down. Allan's mentality here shows that he actually welcomes that. The market throws different prices at everyone every day for the same business that has barely changed within that 52-week period. Continued. Arlington Value strives to be conservative, invests with a margin of safety. When analysing a business, we strive to be conservative and realistic in our assumptions. We are disciplined investors and purchase stocks only when favourably priced. So making sure that he doesn't overpay for a business, making sure that they're getting it for a bit of a discount. And we exercise patience and discipline to only invest in exceptional opportunities. So fiercely competitive markets combined with a limited mental aptitude makes it difficult to find attractive investments, where the risk-reward equation is extremely favourable. He's talking about finding where the best opportunities are, where it's nice and quiet, there's not a lot of other investors looking around for. Because exceptional opportunities are rare, we make meaningful investments when such opportunities are identified. Right there, he's talking about finds a great investing opportunity. He's not just going to invest a small amount. He will then weigh up how confident he is with the investment and then allocate a large part of the portfolio to it, allowing his portfolio to be concentrated as opposed to well diversified. Allan then goes on to talk about his investment criteria and process. So, our success depends on exercising patience and discipline to only invest in situations that meet our criteria. So where he's looking for those exceptional businesses, this is what he's looking for. So from an overall total universe of publicly traded companies, think of this like a funnel. And through each step, he's trying to filter out in that funnel for various things. So first of all, the ability to understand the business. We focus on businesses we thoroughly understand. This eliminates a significant number of potential investments and results in Arlington Value owning many of the same companies numerous times. Warren Buffett refers to this key area being staying within your circle of competence. understanding the businesses that you are looking at thoroughly before making an investment. Staying power. We focus on companies with staying power. We look for long-term, durable, and low rate of change. So having a strong moat is what Warren Buffett would be looking for in terms of making sure that that business has staying power and low rates of change. If there's lots of change, it makes it hard to try and have a look and understand where that business might be in 3, 5, 10 years' time, for instance. If there's a lot of change going on, it's very difficult to make an accurate as possible assessment of where it might be in the future. Quality management teams. We look for honest, intelligent management teams with proven track records. So making sure that they're honest, being candid, telling the truth about if things aren't going well in the business, and also management team is being intelligent. They know what they're doing and they can execute on it, and they have that track record. Attractive price. We only invest when the price is attractive, which provides both margin of safety and favorable prospective returns. So he approaches everything with a value perspective. Strictly adhering to our criteria often results in a concentrated portfolio. So what it means there is he might not have 100 businesses invested in his portfolio at one time. It's probably going to be closer to around maybe 10 to 15 max. So that way he's only got the best investments and that he can in there that are going to have the biggest change for his portfolio. And what he's just looked through there in terms of owning the same companies numerous times, once he's done the effort of finding those companies over the years, he can then look back into them and buy into them or sell into them at different times. Allan's investing criteria and process and his investing philosophy isn't unique just to him. They're the same beliefs, principles, and strategies that other successful investors have used, like Warren Buffett, Howard Marks, Seth Klarman, Peter Lynch, Joel Greenblatt. All these guys use those same core elements to have investing success. They all share those same beliefs, principles, and strategies, but they apply them to different areas of the market. I've spent over 2,000 hours putting the jigsaw of information together between all these different investors, testing these different things out in the real world, and then showing other investors how to use them. They're free. Click the link in the description. They're my gift to you. How did Allan then find Monster Energy using that criteria and then hold it during the worst stock market crash since the Great Depression? Well, in 1996, Monster Energy, then called Hanson Natural, was first entering into the energy drink market. In 2002 was the first time Allan had found them, and he actually made his first investment in them. And Allan was old school. So how did he do it and how did he find it? He read through the annual reports. This is how I also review investments as well. Here's how I find the annual reports. So I'm going to Google and I'm just going to type in Monster Energy annual reports, and I'm going to look for the actual company and their investor relations page. Found it. And now I want to look for 2001's report, the year just before 2002. And it's not there. So we'll look elsewhere. Another way to look for older ones, especially for businesses that are in the United States on their stock exchanges, is the SEC's EDGAR facility. So we can look through the full search or the search filings. For this one, we'll go through the search filings. And I want to type in the original name before Monster Energy, so Hanson Natural. And I want to look specifically for the annual reports, and that's a 10K. So then it'll filter just by those filings, and we'll have a look down, looking at the filing date on the right-hand side, and I want to look for 2001. You can see there's a few different files. 10K or the complete file. We can open that up, just a text file, and you can see the layout that it's in there. You can then zoom in, use Control F to search for anything in particular, and go from there. So this one, See, Hanson Natural. All right, so in the 2000 report, we're looking at the cash or case sales and then net revenues broken down. And this is broken into quarters as well. You can see year on year, the results are growing in case sales. What about net revenues? Consistently increasing year over year, and not by a little bit, quite a lot. So we can see the directors and executive officers of the business. You can see that Rodney C. Sachs, who's 51 years old, he is the director of the company and the chief executive officer. He's been in that role since November of 1990. You can then see a few of the other managers or heads of the business and how long they've been with the business for. Then see the executive compensation area, talks through Rodney's previous salaries during that period, any bonuses that he's received, and anything else as well. You can also see there's no long-term incentive plan payouts, none paid, no plan in place. We want to make sure that long-term shareholders are being looked after, and usually those long-term incentives are where those things can get a lot of bang for the buck. So security ownership, we want to see how much skin in the game these guys have. So I can see that Rodney C. Sachs, he has a very large percentage and a lot of ownership in the business. So he's got a lot of skin in the game. So even without those long-term incentives, he has a lot of skin in the game, and that pretty much levels that out. And we can see consolidated balance sheet. So assets of the business, we can see that they are growing. So assets of the business from 28 million up to 38 million. And then liabilities within the business. You can see the long-term debt's gone up considerably. And later on, we actually find out that that is from a more recent acquisition. So the income statement, where we can see the top line of the business, how much income or sales that they've made. So 53 million, 72 million to 79 million. So every year it's growing. Cost of sales is growing in step, which is good. Costs aren't going through the roof, so their gross profit is still growing. The net income, or the bottom line for the business, we can see that it's jumped, gone up, and then jumped down. Looking at the cash flow statement, we want to see where the cash in the business is being invested. There's a substantial amount in there for increase in trademark license and trademarks, $6.5 million, when compared to last year or the previous year of $1 million. So quite a considerable jump. Net cash used, you can see that there's a huge jump there. And the cash flows from financing, so borrowings on the long-term debt, there's $9 million which has been added in there, which is where they've got the cash for these acquisitions. And see, cash at the end of the year is not too healthy. It's much lower, and a lot of that money has been taken out because they've bought Blue Sky. So what could Allan see? He could see that there was a consistent and experienced management team. They had consistent sales growth year over year. There were huge investments in infrastructure and a recent acquisition that soaked up lots of the money and cash flow for the previous year. And the cash would be paying off that debt for a few more years to come. In 2002 as well, the business stock price literally was jumping around in fractions of a cent. In Allan's 2012 annual report is the first mention of Monster Energy. And so Allan has kept a lot of these greatest investments to himself and under wraps until most of them have either played out or he's happy to talk to them. In it, he says, in 2002, I allocated a small portion to Hanson's Natural, at the time a niche soft drink maker with 92 million in sales. In typical fashion, we sold out as the price rose, smiling at our neat profits. How did that actually go for him? Well, from 2002 up to 2004, the stock price tripled from where he sold. In his 2012 annual letter, he continues, over the next 18 months, my smile turned to a grimace as the shares tripled, settling at a 26 times earnings in Q1 2004. Usually, 26 times earnings is not a valuation that piques my interest. and in fact, most often strikes me as expensive. So after having that missed opportunity and really feeling that pain over the last 18 months of selling out from Monster Energy, Allan's then gone back through and had a closer look at the business and the annual reports that were most recently available. Looking at the 2003 annual report's selected consolidated financial data gives us a lot of information. So from gross sales, we can see that year over year it is increasing. And over a 5-year period, it's almost doubled. The net income over that time, in the last 2 years, it's remained constant. However, I believe a lot of that is being put into paying off that debt that they bought from 2000. Total assets has increased from 22 million up to 40 million in that 5-year period and almost doubling. And the long-term debt, as we can see in 2000, 9.7 million, and in the last 2 years, it has steadily decreased. Having a look at the sales and marketing area, for a business like this, we really want to be having a look at where the business is prioritizing that money to grow the business's moat. And for this kind of business, it's its brand. We see the brand associations that the business management are trying to do. So having a look at sporting events such as Hanson's Energy Pro Pipeline Surfing Competition, marathons, 10K runs, bicycle races, volleyball tournaments, and other health and sport related activities, including extreme sports, particularly supercross, freestyle motocross, surfing, skateboarding, wakeboarding, skiing, etc., etc. And Hanson continues to believe that one of the key areas to success in the beverage industry is differentiation. And so putting a lot of focus on making sure that their products and services are completely different to their competitors. When having a look at Allan's criteria for what he looks for in a business and the 2003 annual report from Hanson Natural, we can see that the business has been focusing a lot on the business brands and focusing on its associations with other events and things like that to get its ideal customer. The brand is actually a type of moat which protects the business in the long term. So we can see that a brand is just one type of business moat. Now, a brand is just something you know and like. You pay more for it because you trust it. So Coca-Cola and Apple are brands many people love. There could be a secret, as in like an intellectual property, special secrets or patents, like the 11 herbs and spices. Could be a toll, might be like MasterCard and Visa get a small fee from each payment that utilizes their network. Could be train tracks, power lines, water pipes, some form of physical infrastructure. Could be switching. So looking at businesses like Microsoft, if your business owns 100 Microsoft style computers, it's going to be pretty expensive to switch to an Apple or a different operating system. And price, a business with very low prices, something like Walmart and Amazon. By keeping their prices low and looking after their customers, that also protects them from other competitors. Now you need to look at evidence, which is also what Allan does. He has a look for it to make sure that where is there actual evidence for it, compares it to their competitors as well to see what they're doing. And he also tests that moat to make sure, is it actually going to perform well over the long term? Now, what else did we see? We also saw that management in the business was very consistent. They had lots of experience and they were executing well on their strategy. So it comes under the big question is, can I trust management? So you want to find managers you can trust. They're easy to understand and they openly talk about failures and they don't hide behind PR fluff. Why is that important? Warren Buffett goes into a bit more detail. He says, we also believe candor benefits us as managers. The CEO who misleads others in public may eventually mislead himself in private. So I want to make sure, is management candid, aligned? So is management aligned with shareholders? And is management rational? And so what Allan was able to see when he's had a look at it, he has actually decided to buy back in and reinvest in the business in 2004. Even with that high valuation, where he said it was 26 times earnings and is usually quite high for him, he's actually rebought back in knowing that the business growth and the trajectory of the business meant that it was also had that more long-term value. So how did the business go in the next, from 2004 to 2006? The stock increased 1,000% from the end of 2004 up till July of 2006 in 18 months. But it all come crashing down. Stock decreased 43% in 5 weeks directly after that. Why? In this Forbes article from 2006, it explains a little bit of what happened. It discusses Hansen shares are down 42% from their high, fueled in part by missing analysts' sales estimates, even though profits rose 86% in its quarterly earnings report, issued earlier this month. The miss spurred a wave of downgrades and a huge volume sell-off. What did Allan think about the business not hitting analysts' estimates? So in his 2006 annual letter, he talks about how he's sold a losing stock. It was a mistake from it pressured into purchasing by his fund partner, Ben. And he's not actually talking about Monster. But what he says is, ultimately, in early August, we decided the manipulation was too much and decided to sell off a large portion of our position. Moreover, we found an extremely attractive idea in which to reallocate the funds. The timing has proven fortuitous, as AVM has increased 45% after reallocating the funds. Now, we can't say for sure he invested extra in Monster because, like I said earlier, he doesn't talk about his greatest investments. He keeps them close to his chest. So what happened? The graphic from 2006 through to 2007, the stock increased from 125% in 14 months. The end of October 2007, the stock decreased 36% in 6 days. And then, over the next 12 months, the stock decreased 67%. Now, if you were investing during the GFC, let me know what you did during that time by leaving a comment below. Your insights will help other investors here. Let us know what you were feeling and what you went through. How did Allan feel about this? Well, in his 2008 annual letter, this is what he had to say. What a year. For the year ending December 31st, 2008, AVM recorded a gain of 10.6% net of fees. This compares favourably to a minus 37% decline by the S&P 500. Our 9-year average annualised return is 11.5% versus minus 3.6% for the S&P 500. His investment strategy is doing pretty well given the market turmoil. He goes on. Our investment mentality puts a premium on figuring out what to avoid rather than what to buy. We're an exciting lot to be around. We prioritise the simple and easy and quickly discard the complicated. These straightforward principles helped us stay focused in a handful of companies that were resistant to the financial malaise in 2008. He goes on, during 2008 we added just 2 significant positions, both of which enjoyed dominant competitive positions and durable advantages. Both companies sell low-priced products and services, characterized by stable demand with ample pricing power. I'm particularly drawn to these types of businesses as they should do well in both inflationary and deflationary environments. Now, we can't say for sure that that's Monster Energy that was held onto or added significantly to during that period. Monster Energy has a dominant competitive position and durable advantages being the brand that it's building around its core products. And they sell low-priced products, being their drinks and things like that. Now, the brand that it has allows it to raise the prices of those in inflationary and deflationary environments as well. So like I said, the best investors keep their cards closest to their chest. That allows less investors to know, and there's less competition around and other investors looking at those stocks in particular. Now, that allows for, if that business hits some hard times, or like they said in that news article, the actual price of the business lowered significantly, that it gives them more opportunity to buy in and allows the business stock price, there's less investors keen to buy it at a low price because they're scared off. Now, Allan talks about owning those same companies over many years. That is one big reason for not letting everyone know about the businesses that you're trying to invest in, because that allows you to benefit at various times because there's less competition. In his 2011 letter, he talks through what makes us different, besides being located above a taco shop. The investment opportunity we seek is simple. We're looking for that rare combination of business safety, an attractive price, and clear understanding that leads to low risk and market beating returns. Our strategy requires us to emphasize Ben Graham's sage advice. There are 2 rules in investing. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. I deem the second rule far more important than the first. Back to setting the scene, in 2008, the stock price has gone down 67%. Allan's still holding the bag of Monster Energy. What is he going to do? Well, based on this information and his investing style, he's held on to the business and he's looking at how that business is actually functioning under the bonnet. Knowing that Allan would have reviewed the annual report from Monster for the latest one, so looking at 2007's annual report, which would have been available during 2008, looking at the selected financial data to try and keep this analysis as short and concise as possible, we can see that they've got from 2003 all the way up to 2007. And we can see that gross sales has gone from $135 million up to $1 billion in gross sales. So that's close to just under 10x in a 5-year period. The net sales and the gross profit over that time as well, from 43 million up to 468 million. So another around 10x. You can see the gross profit as a percentage to net sales has actually increased over that time as well. So it's gone from just under 40% increased up, and it's at the low 50% for gross profit, which is pretty good. You can see that the net income has increased from 5.9 million in 2003, when a lot of that income that they were generating was actually getting plowed back into paying for that acquisition and paying off that debt. By 2004, most of that debt was paid off, and a lot of that money has hit the bottom line. And we can see that we're up to $149 million in net income when compared with 2003, 5.9, so well over 10x. You can also see the total assets have grown by about that same 10x as well, from 48 million up to $544 million. And long-term debt is nearly non-existent. So this business is a cash flowing machine. From the end of 2008 through to 2012, the stock increases 264% in 14 months. In his 2012 annual letter, Allan mentions Monster Energy for the first time, and this is where the rest of those quotes have gone. Now we can have a look at the entire quote in its detail. Selling great companies with large growth potential, even at seemingly rich valuations, is usually a mistake. An example from Arlington's early years illustrates this point, albeit in a painful way. In 2002, I allocated a small position to Hanson's Natural, at the time a niche soft drink maker with 92 million in sales. In typical fashion, we sold out as the price rose, smiling at our neat profits. Over the next 18 months, my smile turned to a grimace as the shares tripled, settling at 26 times earnings in Q1 2004. Usually, 26 times earnings is not a valuation that piques my interest, and in fact most often strikes me as expensive. However, this faulty thinking towards Hanson's would have caused one to miss out on a 5,860% gain over the next 9 years. Fortunately, we didn't miss out on this 58 bagger. Unfortunately, I sold 18 months prior, causing us to miss out on a 200 bagger, where $100,000 would have turned into $20 million. Although the foregone gains make us chuckle, we feel okay because we didn't foresee the energy drink explosion that propelled Hanson's to such incredible gains. Now, if you thought you were late to the party in 2012, think again. From 2012 to 2025, the stock increased 874% over the next 14 years, turning 10K into 87K. I'd be pretty happy with that. In 2012, Allan stepped back and shut down his investment fund. He doesn't enjoy the limelight and he's been off the radar since. He's my favourite investor. for his no-nonsense investing style, staying off the radar, and his candid investing letters. Now let's go over Allan's 4 deadly sins for avoiding losers, picking winners for stock investing success. Allan puts a big focus on batting average. And what he's talking about here is the little graph on the left shows his batting average versus on the right is the S&P 500 batting average. So all that is each business that he's owned over a 3-year period on the left, and it shows the returns that they've had. And we can see that most of those are on the top side from 0%, showing that they've been positive investments. Whereas having a look at the S&P 500 batting average, you can see that it really is just average. And it shows that a lot of businesses do well and over the majority do poorly, showing that really trying to optimize to get rid of those losers is where the focus is. And he says a stubborn adherence to our investing principles results in a high batting average. The high batting average is the key driver of strong long-term performance. So holding those standards high, staying consistent to that strategy that he had, the filters that he's looking for in a great business to invest in, is really getting rid of all the businesses that have red flags so that all he's left with are the winners. You don't need to swing at every pitch. In stock investing, you have almost unlimited pitches. Just wait until the perfect pitch comes and then make sure you're ready for it when it does. Rushing and FOMO, or fear of missing out, is really just fabricated in your mind, and it makes you feel that you need to swing at every pitch, and it's a mistake that holds us back. So how do you stay stubborn and actually do this? He talks through it in his 4 deadly sins. So his 4 deadly sins are: we strive to avoid the deadly sins of the portfolio management, is accepting unsuitable capital, groupthink or lack of independent thinking, overconfidence or self-deception, and overactivity, and insufficient patience and discipline. He goes on and expands on each one of these. Accepting unsuitable capital. So you might think this doesn't apply to us individual investors, but it does. Unsuitable capital misaligns interests and expectations, interfering with one's ability to execute the strategy. Incompatible investors distorts one's investment mentality and can cause one to focus on short-term fluctuations rather than long-term values. And a great quote here from Seth Klarman: the single greatest edge an investor can have is a long-term orientation. In a world where performance comparisons are made not only annually and quarterly, but even monthly and daily, it is more crucial than ever to take the long view. In order to avoid a mismatch between the time horizon of the investments and that of the investors, one's clients must share this orientation. Ours do. As an individual investor, we want to make sure that our biggest edge is being able to, like you said earlier, understand and use volatility as opportunity. And being able to do that requires us to be long-term investors. We can't be trading and having a look at the stock price daily. Otherwise, that will result in us looking at short-term results and getting terrible long-term returns. Groupthink, lack of independent thinking. Relying on others' analysis results in paralysis or panic under volatile conditions. So if we don't have that strong foundation of knowledge of why we've invested in a business in the first place and understanding how it's going to react under certain scenarios, like Monster Energy during the global financial crisis, we'll make emotional decisions and we'll make mistakes. Groups have a tendency to reinforce preconceptions and suppress critical thinking. Seeking consensus results in making decisions with the heart rather than the brain. We want to make sure that our investing is as business-like as it can be. And if we're making investment decisions based on what a magazine is saying, what an article online, or the economic commentators or stock market commentators on the TV, then we're going to make mistakes because we are not aware of how that's going to react. We want to make sure that we're thinking for ourselves and we're doing our homework to make sure that we are investing in great businesses over the long term. Overconfidence or self-deception, an inability to say, I don't know. Investors own too many stocks, ignoring the boundaries of their mental capacity, resulting in excessive mistakes and harmful frictional costs. An average holding period on the New York Stock Exchange is 6 months. Being able to understand and stay within your area of competence, or in the 5 M's, your mastery, have you actually mastered an understanding of the business? You need to be able to say where you know up to. So if there's something that's outside your circle of competence or what you know, you need to be able to admit, I don't know. And that's okay, because at that point you realize it and you can go and do some homework and have a look into it. Start inquiring, do some more research, have a look at what other investors are doing in that space, people that you look up to, and other exceptional investors, like Allan Mecham back in the day while he was still running his fund. Investors that own too many stocks, especially when they're picking individual stocks like this, can actually reduce their bandwidth so that they're not actually keeping their eye on the ball. In most traditional forms of investing, diversification is key, and in which case it's a very passive way to invest. Because at the end of the day, if you're dollar cost averaging into an index fund, you don't need to look at it, you'll just get the average of what results from that big basket of companies. But if you're investing in and concentrating your portfolio, you want to make sure that you're keeping a very close eye on individual stocks. And if you grow that number significantly, you're not going to have that level of detail that you need and the level of resolution around what affects that business externally, like its customers, the economic environment, and things like that. And the average holding period on the New York Stock Exchange being 6 months, that just highlights how short-term thinking the majority of people that are buying and selling stocks. They could be traders, they could be long-term investors, or they could be medium and short-term. But it just highlights the lots of different people that are buying and selling the same business, but looking at it completely differently. Overactivity or insufficient patience and discipline. So unable to sit still without tiring of sitting still. Sometimes the best type of investing is literally, as Charlie Munger says, to find a great business and sit on your ass. That's the best type of investing you can do. Act too often, think too little. Acting too often or just investing for the sake of investing and buying and selling is a way of just destroying your returns over the long term. And it might feel good because you're keeping busy, but at the same time, sometimes the best decision is to do nothing and effectively just hold on after you've checked your investments, check the underlying business to make sure that they're okay and that they're still ticking along doing the work. Relaxing investment standards after a drought of ideas. This is a really important one in terms of trying to maintain and hold the bar for your investments over the long term. You want to make sure that your investments aren't starting to slip down and you're reducing the standard at which you want to hold for them. Otherwise, over the long term, your returns will reflect that and they'll start to decrease. And a quote from Warren Buffett, the enemy of investment success is activity. And the big money is not in the buying and selling, but in the waiting. As individual investors, we have an edge against most Wall Street investors. They have to invest every cent that enters their fund, whereas us, we can keep it in cash and wait for that perfect pitch to come our way. And when it does, be ready. Now that you know how to stay away from the deadly sins, you're ready to learn where some of the best pitches are. It's where Ferrari was hiding, and an investor turned $250K into $25 million. That's a 100x return. Watch this video to find out where to look.